Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. We are coming live. If you have questions, you can ask them right now, and we will answer them live. Obviously, if you're watching this after it's recorded, you can use this email address. Either way, send it to us now or send it to us during the week so we can see, what questions you have. We'll try to answer those on the next show. Obviously, if you're live too, you can sign in to Google and you can use the chat here and put your question in there if you'd like also. So that's what we're doing here. We're trying to help people, with their retirement asset management, retirement planning and tax planning. And so we do that by answering questions. So please feel free to do that. Now we have this channel. We've had it going pretty heavily here since 2020. And we feel like there's a lack of information about how to really successfully manage your retirement, especially financially. So you can subscribe to the channel. You can hit the bell button when we get new content. You can look at what we have on there now and see if you can kind of up your education, so to speak. And of course, if you just want to talk to Ethan and I, we can do that also. We do offer a 30-minute consultation. You go to our website. There's a book appointment button up in the corner. The link for the website's here on the channel, actually. And you can pick a time, in office, video, phone, whatever works for you. I'd be happy to talk to you individually and see if we can help you with what you're working on. So I always start off the beginning of the show kind of with a summary of what we saw happening in the stock market this week. And it's been pretty busy weeks the last few weeks. Lots of stuff going on. So and let me share the chart that we generally look at here. This is going back to 2018, and you can kind of see overall this is weekly data, so it smooths it out a little bit. The market's still, if you look at that all together, obviously we've done really well since 2018. Lots of ups and downs as far as that goes, but the market has great momentum to the upside. There's no doubt about that. It's still moving along pretty strongly. Theoretically, it could be moving better, right? I feel like if we didn't have so many headwinds, there's been a lot of kind of talk about, how great the tariffs have been for the country or what have you. But really, if you take away all those things, we might have a market that's moved much higher than we are now, right? So a lot of these things are kind of dragging on the market. But the market has held up because of the overall spending on AI data centers and what have you that have moved things. The Federal Reserve met, last month, and Chairman Powell came out pretty positive comments to say what they see happening in the economy with consumer spending and those types of things. So things are going well. They could be going better, obviously. So, but there are a couple of themes that are really interesting. I think the biggest theme that's happening right now is that these big companies are being penalized for how much they're spending on AI, right? And the second big theme is that there's a worry, especially in the software industry, that AI is going to kind of replace some of these software companies. So Microsoft, might be replaced by somebody else because it's becoming easier to make software. Obviously, that gives smaller players more ability to move into things. I think that part's actually completely overblown. It reminds me a lot of what was it, DeepSeek? When they came out, when the Chinese came out with a pretty good AI model that they were able to do with less and less expensive chips, right? And NVIDIA got hit pretty hard. And now it's back and running away, So that turned out to be, NVIDIA wasn't going to be replaced and or reduced by that model. And I thought that was kind of overblown at the time. And this definitely seems overblown. Maybe some points in time here to be able to nibble. Now, doesn't mean there's not a threat, especially longer term. But I don't think, for example, Microsoft is going away anytime soon. They've got a really massive cash flow, great financial position. And oftentimes when these companies really get threatened, they'll go out and buy, whoever's threatening them.
Yeah, Microsoft has very much a stickiness to it where so much enterprise and
Right.
is based on having the Microsoft suite.
Yeah, exactly. I mean, we use it all the time. I guess we could have switched at some point in time, but it would be kind of a nightmare because we have so much, documentation, spreadsheets, Word documents, whatever it might be, in kind of a legacy format. So that's not going away anytime soon. And so, the stock dropped, 10% last week after earnings and what have you too, and continues to become down. But, we'll see how that plays out. But anyway, a couple things that we were talking about. So last week, one of the things that presented was this what they call a flag pattern. This is actually a fairly important pattern altogether. And you can see that there's kind of this, motion to the upside. I'm showing what we showed last week, and we actually broke the flag to the downside on Thursday, yesterday. And so the theory is that when it breaks a flag, it should break the flag to the direction it was already going, okay? So it should break through the top, not through the bottom. You can see it's now back into that flag pattern, that we had from last week. That's today, because today's been a really big bounce back day. One thing we are seeing that's very fascinating is we're seeing a pretty strong correlation at the moment between what happened with Bitcoin and the stock market and gold and silver prices, right? So Bitcoin has almost dropped in half as of yesterday. So it's rallying back today. The stock market's rallying back today. A lot of and silver and gold are rallying back today. And so Bitcoin's, in cryptocurrency as a whole, Bitcoin was just one of them, obviously, but it's kind of fascinating to see, what connection that has to the overall markets outside of cryptocurrency markets. What we saw in the past with some of these big downturns, and the reason I bring this up is because, oftentimes it's something that wasn't related to the market. It was credit default swaps in 2008. It was, which were insurance policies on top of these subprime loans. I remember looking at our portfolio thinking, oh, we don't have any subprime loans. Well, the whole market came down because everybody had to sell off to pay off these credit default swaps, these insurance policies.
Yeah, it's like a margin call where, if you get called for one bad investment, you have to sell other investments to cover your costs.
Right, and there seems to be a fairly heavy correlation between the metals, gold and silver, and Bitcoin, even stronger than the stock market. And so, you could see the possibility of people selling silver in order to cover their margin calls that they might have on Bitcoin, which obviously then becomes margin calls on silver as that starts to drop. And so that's kind of the cascade. And so we've seen some volatility there as far as that goes. And I'll talk to you about silver here in a minute. But so what I've done here is we just, you readjust the flag pattern to that new low, and, we'll see what happens, right? And it is an important pattern. Again, we'll have to see where it goes from here, but it's something to watch for. And again, theoretically, it should break through the top. And if it does, it should run fairly heavily, right? The challenge we have, as I mentioned before, is that the market probably should be going up here, not making a flag pattern. But all these headwinds that the administration has put into place have really kind of created this situation where, yes, the market is doing okay. But really, if you look back at the .com and you compare that to the AI spending, it should be doing better, in my opinion.
Yeah, and we're starting to see other economic factors too. Like there's been a lot of historic layoffs right now too.
Yes, yeah, and and new job openings are down quite a bit. First-time unemployment, so the job market is definitely softening. We were supposed to get the jobs report for January today. It's the big report that's put out by the government, and it's been delayed, I believe, till Wednesday because of the government shutdown that we had. It was a short shutdown, but nonetheless interrupted. So we'll see what happens next week. I'll point out another positive here. Flag pattern's good. Nothing wrong with flag pattern, especially because we're already going up and not down. All right, so the continuation of flag pattern should be going up. The other thing is, if you look, each one of these arrows, each one of these lows is higher than the low prior. Okay, and so that's important. So the market is still, at least in that time frame, kind of showing a primary direction on the upside. It's one of the things we watch for. When the market's going up, you want to study the lows, right? When the market's going down, you want to study the highs. And so again, so far that pattern is still holding. Combine that with the flag pattern. And then I've been talking about for quite a while, they were basically going sideways, right? I mean, we just have this sideways motion, which is a positive. Even though, people get scared because we've had these downturns, the big downturn there that, at the bottom of that pattern is back in December, is just, the market has run so hard, it's gone so far, It has exceeded, most other markets historically in terms of valuations. And so having it go sideways for a while allows earnings to catch up. And earnings have been doing well. We're getting earnings reports that are coming in. The market's responding negatively to some of that, but earnings have grown 15% so far on the companies that have reported year over year. That's a good number. That's a solid number. And earnings have not been, even though there's some weakness in the job market, and the market's reacting to that weakness in the job market. However, the job market is a massive lagging indicator to the stock market. So I always kind of get amazed that the market responds that heavily to it, because if you think about it, it takes a long time for people to lay somebody off. And the market is already factoring that in a long time ago as far as that goes. Earnings, on the other hand, are less of a lagging indicator. We're looking at earnings for the fourth quarter of last year now, but it's closer, and it's more closely related to the performance of the stock market.
Yeah, we've also seen a rotation.
Yes.
Just the international and small cap have done better in the last month compared to just the S&P 500.
Yeah, we talked about that last time, right? So the equal weight S&P 500, the international, the small cap are all doing better than the S&P 500. We started to add some of those to our models for that reason, obviously, too. And you've got this situation where, that's another healthy sign.
Yeah, because the market still has appetite for risk.
Yes. Yeah, exactly right. And you can see that. I mean, the reason that silver did so well. And so that shows kind of where the mentality is of the market as a whole as it starts to spread out. And that's a normal, healthy market. You'll get this narrow move out of those low downturns in stocks that people really believe in, the Mag 7. And then eventually those will kind of peter out. And if the appetite's still there and the market still feels comfortable, you'll start to see that spread out into more aggressive areas, like we just mentioned, really, the mid caps, the small caps, the international, et cetera. So that's happening, and we talked about that too, and I think that's another positive. Here's something that's a positive, but this is always hard to get your head around, okay? So this is a survey that Bank of America does to basically ask, in this particular case, it's professional investors, are you feeling like, the market's going to go down or going to go up? Are you going to be selling or are you going to be buying, right? And so we're at an extreme selling component right now. The measure is 9.6.
But it's an extreme bullish.
Yes, right. And so that's the flip.
Yeah,
right?
The contrarian signal.
So they're answering that they're selling. And if you have enough people saying that they're selling, the market has more chance of going up than down, which is hard for people to kind of wrap their head around sometimes. And so that's the key thing, and that's what's kind of understanding. And whenever you see this arrow get way over there, we've had a lot of nice runs. We did have one of these that came in December, back in that particular downturn. Market didn't make a big run out of that. We're a little higher than we were as far as that goes, but it didn't fall farther.
Yeah, but if you're looking at this contrarian, when there's extreme bullishness in the market, it may be time for you to start to hedge down your positions, maybe your more higher volatility positions.
Right, and there's a logical reason for this, and the easiest way to wrap your head around it is that, when everybody's answering that they're selling, they're probably done. Right? And so it leaves the buyers. And so buyers can be a smaller group, but if the sellers are already done, the smaller group of buyers can come in and turn the market around. And all of a sudden, you get the short covering, you get this, fear of missing out that comes in, and the market can start to kind of rally off of that. So that's actually a good sign also. I'm trying to point out some of the things that I think are good here. The flag pattern, the higher lows, the broadening of the markets, the, bull bear indicator being, so negative, which is positive as far as that goes. So, those are things that I think are pretty important to understand about the stock market right now. And again, in my opinion, we'd be farther along if we didn't have so many of these things in our way. As far as that goes, but nonetheless, we're still going, I think, in the right direction. We're getting to a point, though, here over the next few weeks, maybe few months at the most, where there's going to be some important, benchmarks that we're doing. Do we really fall down and start to set lower lows? Or, do we break out of the top and start to move? Do we finally get through 7,000? We actually got through 7,000 once or twice in the middle of the day, but never were able to close above it. So that could be a nice psychological boost if that does happen. So we'll see what happens so far. But wanted to talk a little bit about silver because we made some changes this week for those of you that are clients. The two green arrows there are when we were buying silver. Now, we don't have silver in all of our accounts. We only have silver in our kind of our more aggressive accounts that have more stock market exposure. Our more conservative accounts, silver's too
volatile.
Too volatile. And we bought gold kind of at the same time. We don't have those. And then we have our ESG portfolios, environmental, social, governance portfolios. Silver mining doesn't fit within an ESG component. So we don't have silver or gold in those, portfolios either. But we do have this in quite a few accounts. And, by chance, it took off and it went bananas. And so the first red arrow there is where we rebalanced. And so what happens, let's say you have a 4% position that we want to have in silver, but silver nearly doubles, which it did by that first arrow there. And so now I have an 8% position. And so we rebalanced it back down to that 4% position. So we took our profits. Now, we did not take our profits in those taxable accounts for the most part, mainly because there's a short-term capital gain that comes if you don't hold on to it for a year or more. We might still sell it. There's no use holding on to it and watching the gains completely disappear. You're better off paying some tax than having no gain whatsoever, right? But it's a fine line. So we did that rebalance. And then this week, that second red arrow, we went ahead and sold off the rest of the silver position that was happening in those tax-deferred accounts, IRAs, 401ks, where we don't have a tax consequence to sell that. We still had, I think, a 40% gain, give or take, on those positions. And this is just one of those things where you kind of got to take some profits once in a while. Silver could take off and be the next greatest thing ever, but pretty happy with, nearly 100% gain on half of it and 40% on the rest.
Yeah, especially
again, I'm generalizing here.
The volatility for the last couple of weeks have been so high. It's starting to kind of not fit with the portfolio. Risk-wise. The irony is, even with that chart there, and we had last Friday when we were here, it was down like 26%, 27%. It's still like break even, slightly above break even for the last 30 days. So it had just such a phenomenal up run there. It was pretty wild to watch. There's some reasons for silver to do well. I still like it as a holding from that standpoint. It's in electric vehicles, it's in, solar panels, it's in AI data center because it's the most conductive metal. However, I read an article saying that copper is like 97% of the conductivity of silver, and that's the problem for silver. If it goes so expensive, then people start switching over. It's called demand destruction, especially when there's an alternative. And I think silver also kind of fell victim to just rampant speculation.
Yeah, no kidding.
You really, with commodities, unless there's some sort of major shortage or some sort of major change, you're never going to have a ramp like that up.
Yeah, that's right. Yeah, exactly. So people were leveraging and using margin, and read a lot of articles saying about what was going on in China with Chinese investors and such too. And so, whatnot. Anyway, I just wanted to kind of pass that along to those of your clients, so when you see these confirmations come through, what we're doing, and you'll know why. If you still have it in your portfolio, it's because it's taxable. We're kind of holding on. And if you don't have it, it's because you're in an ESG portfolio or a more conservative portfolio, right? I mean, so that's kind of just to explain what's going on. But nonetheless, so really interesting time frame as usual. Lots of things going on here. We are seeing a ramping up in Iran or against Iran. We're seeing oil and energy prices going up fairly consistently. I think because there's some expectations that there might be a strike there. We're looking for distractions right now. We got the dump of the Epstein files, so we've had so many of those, with Venezuela and what have you. this is probably what possibly is the next one. They just issued an order, I think last night, telling all Americans to get out of Iran, right? So, who knows what they're really planning there. We'll find out. But, that's another piece that the market will have to digest. Every time something like that starts, there's a concern. The market usually pulls back, especially when there's oil involved, which can have an impact on the price. So we'll see how that plays and what really happens if it's as far as that goes. So always something to watch out for at this point in time, that's for sure. All right, so that was our summary for the week. I'm glad that you were able to join us for that, and we'll launch into kind of the questions. These questions come from, now if you sent them in, or I sent them in last week, or questions that we've been getting from clients in our strategy sessions. So that's, always kind of fun. What's our first question?
So what did you see that made you want to get more defensive? You kind of removed volatility with silver and then a couple other of your targets. What was kind of triggering that?
Yeah, I think the biggest thing, silver was just, hey, let's not get too greedy. We've already made money. We're still up a lot. Silver was bouncing off of a support level that I felt like, hey, if it breaks that support level, it's going to free fall a fair amount because there wasn't much support below that. Mm-hmm. So let's just take it. We're up, and again, we're doing this in the, IRA type accounts and 401k, so we don't have to worry about taxes. And there's, so that's a big deal. And so that was just a little bit different reacting to how silver was reacting. But overall, if you look at, especially on Thursday, it was red everywhere. And what we've been seeing is a lot of pieces of the market have been holding up and still green or a lot less red. And Thursday was red across the board. It was very strong. And so you start to see that type of selling. It's just something you don't see all the time. And that kind of drove me to say, okay, let's take a little risk off the table, and just be a bit more conservative at this point in time. We've had a chunk of T-bills for quite a while. That's looked pretty good at the moment, because the market has been kind of going sideways for a while and or down, just recently. So today's bounce is good, right? And that's positive. But we'll see what that follow through is. When you're in the middle of these sideways motions like this, honestly, the motion up and down until you either break out of the top or fall out of the bottom is really just noise to a large degree. Mm-hmm. But I was struck by the amount of red that I saw on Thursday. And so we made some defensive moves, including silver at that point in time. And, we'll see how that plays out.
We're still keeping the majority of the stuff in the market still, and it's just essentially taking a little bit of the higher beta positions, like the ones that move a little bit more extreme than the market, kind of to lower the volatility. Yeah,
we still have really big positions. Majority of the portfolios are in Vanguard Total Stock Market Index, which is essentially every stock for all intents and purposes here in the U.S., and then Vanguard Total World Index, which again is essentially almost every stock in the world. I think it's about 85% of the stocks. And so, those are great core holdings. No matter where the money goes, you probably have some investment in that area, whether it's small cap, mid cap, value, energy's going up, whatever, international, right? Yeah. You got it covered between those two. Still a lot of American stock focus, which I think is important if you're an American stockholder. But we are seeing a pretty good run out of international. So, that's something we're actually adding to the portfolio.
Yeah, it's definitely floating up on the list.
Yeah. And so we have this kind of core positions, and so we keep those unless something's really happening in the overall market. And what we mostly work on in the margins is these target positions, which are much smaller. The silver, if you might have 4% in silver or something along those lines. And so that's where we're just trying to, take advantages of some of the trends that we see and see if we can, kind of outperform that broad market. But most of the money's in the broad market. Yeah, so that's a good question.
So, with AI company or many of the AI companies having their big earnings this week, are AI companies locked into large capital expenditures for the foreseeable future, even if the market doesn't react positively to it?
Yeah, I guess when they're saying AI companies, they mean Microsoft, Amazon, Meta, and whatnot. They're not the true AI company. I guess like OpenAI, which isn't public, but but it's the companies that are spending money on AI. And yeah, I think they are committed to it. As a matter of fact, it's been kind of striking during the quarterly calls that they're, really going after it and saying, hey, over the next, 12 months, we're going to spend hundreds of billions of dollars.
Yeah.
And for the most part, they're getting penalized for those words. But I think one of the things that happens within companies is sometimes you look at a quarter and a quarterly report and you say, this is probably not going to go well. Let's load up on all the negative so that maybe the next 3 quarters, we don't have to talk about those as much. The real issue, though, is that you can't stop halfway through on a data center. Yeah, maybe slow down, right? The investors are penalizing these companies for spending this money. Maybe they slow down. We'll see. And that would have an impact because it is the thing that's really keeping, the market going, as far as I'm concerned as a whole, or the economy going even.
Yeah, and it's hard to slow down the spending too.
Yep.
Is like when you build a data center, you can't just say, hey, I'm going to stop halfway through. It's
Right.
really, there's going to be a lag period before. And so I think they're really trying to get ahead of the demand, the AI, like just the technology demand that they will have to have. And so it's hard to stop it. There's so much inertia. Like these projects, you can't build a data center in a week.
No, they're huge and they take all kinds of time. There's regulatory issues to deal with. They've got to figure out how to get power, how to get water, how to cool the data centers. It's really a huge projects, and there's big money going in there. Yeah, I think it's going to be very fascinating. One of the things that's getting lost in all this is that these companies are investing in the future for themselves. It's competitive. Everybody's racing to try to get to, the best spot, right?
Mm-hmm.
AI-wise. And I have a lot of trust. These are companies that are unbelievable, that have been through a lot of dips and problems, recovered from those. They have so much cash flow. Sometimes if there's an issue, they can get out of it by buying something that's really working. Facebook bought Instagram for $1 billion. That was an unbelievable investment. So those types of things that are out there, I guess I am siding a little bit with the intelligence of those companies as a whole. We'll see how it plays out.
Yeah, you can kind of think about it as kind of like an AI Cold War, where it's basically just an AI arms race.
Yeah.
And so each of these companies are trying to race to be just the best. And so there's going to be benefits for everyone kind of by having so many companies race to be the top. And you're going to have losers and winners. And so we'll see some of these companies that will underperform the market because they just didn't do as well in AI.
Yeah. And I think there's a couple standouts that are interesting to me. Google has Gemini, but they have an unbelievable data. And so in order to train these AI components, you need data. And you can't just use anybody's data. New York Times sued, I think it was OpenAI, I can't remember, for using, their previous articles.
Yep.
Which are copyrighted. And so Google has, with YouTube and Chrome and et cetera, they have a lot of data. So I think that's going to be very interesting to see how they do. And they've been doing AI for a lot longer than most. They just didn't really maybe push it as much as they're doing now.
I think Google's models are pretty good.
Yeah.
I just think they didn't feel as comfortable as OpenAI to
Right.
push out their models to
Right.
everybody.
Yeah, at the time, and AI kind of got the jump on them, The other one's Apple, which isn't doing AI, probably because they missed it. I think, there was some effort to do so. But they also have a really good platform with the iPhones and, what have you. So they may be able to sit back and say, okay, let's wait and see what happens, and then we can jump into that. And in the investing world, that's what Vanguard does. They're not the first one. They didn't invent ETFs. They weren't the first one to open ETFs. But they waited, they saw how to make them, how to package them, and then they came in, and now they're the biggest ETF player. And so Apple could be in that category too, kind of interesting. So I think it's going to be fascinating to see how this plays out. We're probably talking about 2 or 3 years before we really know,
it
if
took a
there's
long
winners or
time
losers, or even if it works, right?
Yeah, because you can think about the .com. Like how long did it take for us to know the winners and losers of
That's right.
.com?
Right. Yeah, there was a lot of them that looked like they were going to really go. And those are in the dustbins of history at this point in time. And then out of that, of course, we got the Amazons and those types of things that have really done well.
Yeah, because you can kind of think of like all the things that products that we use today that didn't, or like their initial companies didn't survive, like Vaughan, delivering groceries off the internet.
That's right. I remember that.
And like now, how much of our groceries, how easily you can have it delivered.
Yeah, Amazon Fresh kind of came along.
Yeah.
Yeah, they were too early for the demand, and eventually, well, the pandemic certainly drive that demand too. That helped as far as that goes. Yeah, I think that, the one thing that doesn't get counted here, we're talking about these big companies and how they might generate, but the biggest gain worldwide will be the productivity gains that come from using the tool. So it wasn't like Amazon's huge, but that wasn't the big thing from the .com. It was all of us that were able to benefit from what happened out of the creation of the internet and the efficiency that came from that. Every company was able to do more with less, have higher earnings. It drives the whole wealth, right? Mm-hmm. And so AI isn't just about, who's going to make it. Is it going to be a productivity tool that makes the world, wealthier, right?
Yeah.
It has that. I remember the .com thing. There was a lot of worries about job destruction, right? And rightfully so. And that's the worries that we're seeing right now about AI. But it's a funny thing. It's just, the more productivity that happens, the more things can kind of continue to grow. There are people that kind of get left beside, and that's where you kind of get some of these tensions that happen too. But that's going to be interesting to see how that plays. All right.
So what are the pros and cons of momentum investing?
So momentum investing means you're buying something that's already moving. And because the opposite of that would be value investing, where you're buying something that's fallen a bunch and it's gotten cheap. And really you can get to the extremes with the dip buying. And so Warren Buffett really probably is the best example of the the value investor. And he was taught by a gentleman that wrote the book on value investing at University of Columbia. And so he used to buy things that were really inexpensive. When you looked at like the value of the machines, and the stock was selling for less than that. Mm-hmm. Yep. A lot of those didn't work. And so Berkshire Hathaway, ironically, the name of the company comes after a textile firm that they bought that failed. And so they ended up starting to buy, good stocks that had fallen on harder times. Apple would be a great example. They were the largest holder of Apple for a long time.
They went to the banks in the 08.
Yeah, that's right. Yeah, J.P. Morgan, huge investments. They tend to step in. So momentum's just the opposite. You're buying something that's already high, at least high-ish, right?
And you're riding that price.
And you're hoping that momentum continues, right? And then you get off of that wave and get into the next one. So the advantage of momentum investing is that it's already on the move. There's some feeling of confidence because it's moving for a reason. Mm-hmm. Usually there's something happening. The company's gaining market share. Their earnings are good. That category of stock is exciting, whatever it might be. And so that's the big advantage. The disadvantage of momentum investing is that you're already buying something that's fairly high. Mm-hmm. If it contracts, you could see, a fairly big drop. And we've seen that, like with NVIDIA, it dropped 40% in 2022.
Yeah.
And it's back. It's way above that at this point in time. But NVIDIA would be, I think, a pretty good example of a momentum stock for the most part. So if you're buying it now, it's already had a big run. You're hoping that it continues to have a good run, which it very well could because they kind of have a lock on some of these, better chips.
Yeah. So some of the cons are it gets crowded and a stock can become very overvalued, and it creates kind of like a bubble situation where if there's a contraction, it's a very sharp and steep contraction.
That's right. Yeah.
And then also, depending on how you structure your system, you could have high turnover, which you're selling and buying a lot of different stocks that can have a lot of tax and just transaction costs. So you have to, there's other just susceptibility to that. And then also you're less reliant on, fundamentals. Value is very much a fundamental investing. So you're just looking at price trends, technicals. And so that can make it easier or harder. If you buy a company that doesn't have good fundamentals because it's just on a good momentum, when it crashes, it could just lose everything because the fundamentals are bad underlying.
Yeah, exactly. So, we're seeing that with Bitcoin in a way. It's not a company, but it's the same thing. The fundamentals there's nothing behind it. So it dropped almost 50%, from its high. And so when things, they don't have a net under them, versus, hey, I'm buying something that's, really cheap already. It's already, below the value of the machines. Probably doesn't fall as much. So, just a contrast between the value and momentum investing. And momentum, yeah, you can have companies that have no earnings, no revenues. And you're exactly right. They're just looking at price. And I remember during 2020, that was one of the better momentum markets I remember. And you had everybody, there was no sports betting, there was no sports. And so people were doing the Robin Hood. And I remember this couple, well, we buy something that's, doing well, and then we sell it when it stops doing well. And then we buy, it made it sound pretty easy. And so the problem that I see with momentum investing, and you kind of pegged that, but the turnover happens because you can't tell what's going to be a momentum stock until it's already moved, and stocks don't generally move forever, right? So it's already moved for 3 to 6 months, 12 months, whatever your time frame is that you're looking, and maybe it moves for another 6 or 12 months, but then after that it peters out, and you're then looking for that next momentum, that next wave, and so you end up with more turnover than maybe some of those long-term holds you might have in a value situation.
Yeah, and momentum does really well when the primary direction of a market is up, when everything is kind of going up.
Yeah.
And so I think each, momentum and value each have their place, and there's certain time periods where one will do better than the other.
Yeah, when the animal spirits are high and people are willing to take risk. That's what drives a momentum market as a whole. When everybody's freaking out, there is no momentum unless you're shorting the market, and then going the opposite direction of the market and playing that momentum to the downside. There is no upside momentum. And, go back even to the 22 downturn, it was down 28%. It was difficult to find momentum stocks. They didn't last very long enough to really, make a profit in them. So, yeah, it's you end up kind of giving back some of your gains if you're not careful in those markets really quickly. All right. What do we have next?
Should I gift stock or cash to my children? I'm thinking about trying to kind of help them out a little bit, but I don't know. I have some appreciated stock, but I can also give cash. What's the better options, and what's the pros and cons of each?
Yeah, it's a great question. Let's say I bought a stock for very little compared to what it's worth today. I've got this big gain. And so what do? I want to give some money to my kids for whatever reason. And so if I give cash, that's pretty simple, right? I can give that to the kids, and there's no real issues with that. There's some, if you give a lot, we won't get into the whole gift taxing thing, but just essentially, the only problem with cash can be you're using your cash reserves.
Yeah, you're giving up your liquidity or
Right.
your buffer.
And maybe you have plenty. That's fine. So everybody's situation is different. But if you don't have plenty and all of a sudden you've given your kids a bunch of money and then everything falls apart and you kind of need that liquidity, right? You don't want to go back to your kids, that's for sure. So that's, you just have to be careful with that. Make sure that it's excess liquidity that you're giving away. The advantage of giving away stock is that you don't have to sell it, and you can diversify a bit. So if you have a bunch of this stock, I can say, okay, I'm going to give X amount to my kids, and they, can sell it, and they pay the tax on that gain. I don't have to pay the tax.
So they inherit it at or they get the gift at its market value for the gift, but their cost basis is your cost basis.
Yeah.
So if you had you've held the stock for 5 years, it's considered they've held it for 5 years.
Yeah.
It kind of just transfers over to them. And so depending on where they fall, I guess the question is do your children have immediate needs, or is it more of a long-term kind of investment? If they have immediate needs, cash is always king for any kind of immediate thing.
Yeah.
Unless the only time where stock could be better is if your children have basically next to no income, and they would be in the 0% capital gains bracket.
Yeah, what's the top for the 0% capital gains now for a single filer? I remember having a client who used to gift $40,000 worth of stock to their child who didn't have any income. At that time, you could sell and take a $40,000 gain, and there was zero tax. So capital gains does have a 0% tax bracket. It moves up all the time with inflation and what have you. But so, again, if you have a child making, $300,000 as a lawyer or something, then, tax bracket might be kind of high for them as far as that goes.
Yeah,
But
and so like the 0% tax bracket for a single unmarried individual would be just below 49,040 or $450. So if they had
got a child, doesn't have a job, you're trying to help them pay their bills, what have you, you could give them the stock. If you sold it, you might have to pay 15% capital gain or something like that. You give it to them, it's under 49,000, they don't have any other income, they sell it, they have zero tax on that. And so that's a big advantage. Again, it depends on the situation,
Yep.
which is always the answer, unfortunately. I think the other thing that's interesting, and this is just sort of a sidelight thing, but if you're just trying to transfer wealth, to kind of get it out of your name, and if the child doesn't really need it, they might keep it. And if it's a great stock for you, it might be a great stock for them. And I have a lot of people in my practice who have stocks like that they got from their parents that they did keep that are now worth a lot. Now, the problem is the cost basis is really low for them too, so it's hard to sell. But you're basically kind of putting together a lottery ticket in a way if it works out, right? So they might sell it, and honestly, you probably don't have much control over that or shouldn't have much control over that.
Yeah, once you give a gift, it's their control.
Yeah, but that's the one advantage of giving stock. They might keep it.
Mm-hmm.
And if it's a good company, then that might be something that's worth it. If you give 40,000, like we just said, worth of stock, you might be able to, that might turn into 100,000 or 200,000 or whatever it might turn into over the long term. And then one thing about having stocks that are doing well, it gets you interested. If you have a child that's not interested enough, in your opinion, maybe gifting them that stock would get them kind of going.
Yeah, a learning experience.
Yeah.
You can use it. But gifting a stock, you're also giving up the step-up basis.
Yes. Right.
And so, like, when you think about estate tax purposes, or estates, is if you were to wait until you passed away, the stock would be stepped up to market value for the cost basis.
Yep.
And so if you're below the threshold, which is $15 million right for 2026 per person, there's an idea to hold on to you if you think you're going to hold on for the rest of your lifetime.
Yeah, if you paid $1 for a stock that's now worth $100, and you gift that to your child, when they sell it, let's say the next day, they're going to have a $99 gain, right? If, on the other hand, they inherit that from you, there's a step up to the current value, which again we'll say is $100. And if they were to sell it immediately or what have you, they would have no gain. So that's another strategy there, is you hold on to it so that when it gets passed to the next generation, there's this step up in basis and it wipes out the tax. At least for that, it just moves, the tax bar up higher. So yeah, all really interesting things and strategies and, questions to look at and to think about. And again, your situation's different.
It's highly dependent on what your kids and you wanted to accomplish.
Exactly right. What's the scenario? I think that's where we come in, is to try to help with those situations and dig through all the different, ifs, then, what if scenarios, and try to figure out, okay, what's the best for this scenario and how does that work? And, trying to do that on your own, you might miss something as far as that goes. Okay, well, that's it for the show today. I really appreciate everybody joining us and look forward to being able to come back again next week. Again, send in your questions. Send them in, during the week here. You can send them to AskTom, talkmoneywithtom.com, and so we can kind of take a look at them and get ready for them for the next show. Of course, you can subscribe to the channel, hit the bell button if we're, going to put out new content. You'll get notified. And then, of course, if you just want to talk to us, feel free to book an appointment. You'll see that at the top of our website, and we'll give you a free half-hour conversation about your situation, whether you're a client or not a client, as far as that goes. So anyway, thank you very much for coming, and we look forward to seeing you again next week.